Short options have theoretically unlimited risk when they are unhedged. An unhedged short option contract has the reward limited to the price the contract was sold at, but price can go to any level, creating unlimited risk exposure if it doesn't have a hedge or stop loss set at a buy to close level. It can be very dangerous to hold a short option contract with no hedge in place, as it is unlimited risk. Professional option traders almost always hedge short options with a cheaper long option contract or the underlying stock. Theoretical option trading are not the same as trading with real capital at risk. Learning about option Greeks and option plays and trading them with real money at risk are very different experiences due to ego and emotions. Research, study, and simulations don't contain the element of risk and uncertainty that the potential for losing real capital does. Be prepared psychologically for the stress, emotions, and ego that you'll experience with capital at risk. Don't let the rush of feelings take you by surprise. Start with small position sizes and work your way up to more size over time. Be ready to manage your mind, emotions, and thoughts in the option market. Trade your option strategies consistently but adjust to the price action. Trade your system based on your own parameters and signals, but don't blindly take the same types of risks in all market environments and on all charts. The current directional market trend of price action and the level of volatility, and adjust position size and directional bias to stay with the profitable path of least resistance on the chart. Not all market environments are suitable for all types of option plays. Know the difference. Liquidity is the first fundamental filter for options trading. Only trade options with highest volume of interest so you don't lose a large percent of your capital on the bid/ask spread when entering and exiting trades. You must trade on the option chains that have the liquidity to trade with spreads measured in cents and not dollars. Don't let a losing option trade get out of control. Define your risk in every option play before you enter it, whether long or short. Set limits for risk of capital as well as delta, gamma, and theta exposure. Regardless of the option play, manage the risk exposure by exiting long option positions, moving hedges, rolling options out in time or strike, or closing option legs. Always be aware of the current risk/reward ratio in a current option play and exit it when the real risk is no longer worth the potential reward. Know how to lose quicker on an option trade. A losing option trade should have the loss cap to the hedge or the stop loss level on the stock chart. An option trader should never lose more than 1% of their total trading capital on one option play. Most long option trades should have a position size between 1% and 2% of total trading capital at most. The stock chart is more meaningful than the option price to have a technical price level that is meaningful. Long option risk must be managed primarily in the position size, as options can go to zero. Don't trade too big or let a losing trade get out of hand. Know where you are getting out before you get in. Diversify your watch list of stocks, types of signals, and option plays. An option trader needs a diversified watch list of option chains to trade with different types of plays to choose from based on the current market range and trend. The more types of trading edges with options you have to execute, the greater your odds of success through different types of market environments. Multiply opportunities with multiple edges based on math and probabilities. Keep your option trades as simple as needed. An option trader doesn't need to create complex four-legged option trades to make money. A trader only needs a repeatable edge to profit from the options market. Complexity can add risk and unnecessary trading activity. All that matters with options trading is probability, volatility, repeatability, profitability, and the quantified risk/reward ratio. Profitable options trading can be simple. The edge is all that matters. Your wins just need to be larger than your losses on average, or you need a high win rate with small losses. Patience can be an option seller's edge but an option buyer's weak spot. An option seller has the benefit of time as theta decays continually, and they can let the clock pay them in time on the option buyer if the move is not in the buyer's favor. The option buyer doesn't have the luxury of time, as they must be right about the direction of a price move and also the magnitude of the price move along with the time frame in which it will occur. Time is the option seller's friend but the option buyer's enemy. The direction and momentum of the price trend determines who the pressure is on until expiration. Anything can happen in the markets at any time. Always accept anything is possible in the markets at any time. Don't think something has to happen or a market can't go any higher or lower after a long trend in one direction. Think in probabilities and possibilities, not certainties and strong convictions. Option traders must stay open-minded to all potential outcomes and accept reality as it plays out. Never expose yourself to the sudden risk of ruin with too much open-ended and unhedged short options. One big risk event can wipe out all your gains at one time. Hedges are cheap insurance against ruin. Always manage risk through proper position sizing with long options and proper hedges and stop losses with short options.